The first presidential debate is now in the rearview mirror, and investors are looking for ways to play the market ahead of the election in November. And joining us now to help us understand how to do just that is Alex Saunders, head of quantitative macro strategy at Citi Research. Alex, it's good to see you. So you were previewing this debate for your clients, Alex. You said, you thought the debate's policy discussions would be rather surface level. You nailed that one, Alex. Then you go on to say you thought the market effects, such as they may be, would be rather short-lived. How come, Alex? Why did you make that call?
Yeah, I mean, the big point to make, and we wrote it in our preview yesterday, is that we're still very early in the election cycle. Right? We don't have debates this early. I mean, we're still in June. And one thing that didn't change last night is that we're just one day closer. The reaction of the betting markets is quite pronounced in terms of Trump's prospects, but it will take a week or so before that's reflected really in the voter polling. So the market reaction that we did see was quite mild, and it mean reverted. As you had said, we expected that debate to be policy light, and it was policy light, but there was some incremental information that we took from the debate yesterday. Trump leaned into the tax cuts, and there was nothing really of substance on entitlements or the deficit questions. He pivoted away. Neither candidate really addressed those concerns. So we think that later in the cycle, those fiscal concerns could come to the fore.
Alex, in the wake of the debate, I'm curious what you're hearing from clients, what questions they have, what concerns they have. What are they coming to you with today? Yeah,
so it is really focused on the rates market, I would say. And the point that we would make on that is, in terms of the market impact, the makeup of government is crucial. So split Congress is much more bond market friendly because there's just less capacity to implement some of these large potential policy changes. So in that sense, if and how Biden's performance yesterday affects down ballot Dems is also important. They were polling ahead anyway. But for the moment, it really is a rate story. We would say that currently there's an uneasy tension between these fiscal concerns and the deficit, and then the cyclical factors such as slowing growth, the labor market that you had mentioned earlier, and a dovish Fed. And we don't expect that to be resolved in the near term. Both the market and the Fed are highly data dependent. As we move closer to election day, and if the polling leans towards a red sweep or even a blue wave, those concerns become more important. But between now and then, there's plenty of macro relevant data.
And Alex, you do point out broadly, election year is typically strong for equities. Just break that down for us. What do the historical patterns teach us?
Yeah, so typically you have strong equity performance in an election year, and that performance is even stronger when you have an incumbent running, as we have now. But the other thing that we highlight for clients, and again, it goes to that we're still quite early in this election cycle, is around about 2 to 3 months, according to our studies, not just in the US, but also global elections. You do tend to get a bit of a risk premium built in. So it's a small pullback, as you might say, in equity markets. So that's something to be aware of. But again, that is a Labor Day, post-Labor Day story, September time, rather than something that you should be worried about now during the summer, where we have Fed meetings, we have another earnings season, and Citi even thinks that the Fed will potentially cut rates before there is an election.
Well, and Alex, to your point, you're sort of talking about this dual drivers for the market in the election and the Fed. The Fed has consistently been the more important driver, right? And this is something that we have heard from strategists over and over again. So do you think then, as we get to 2 months out from the election, say, that will flip and that the election will become more important than the Fed? Or do you think the Fed is still going to hold primacy there?
No, I think there will be an inflection point. There will be an inflection point from the Fed. Again, this will probably be post the September meeting towards election concerns. And to a certain extent, it will depend on the polling If we do have something where it looks like there's split ticket voting and we could have a split Congress, which is quite likely given the electoral map in the Senate, in the case of a Democratic win, less likely, but the House is more challenging for Republicans. If we do get a split Congress, I think the bond market will be breathing a sigh of relief. But if polling leans either way, then those fiscal concerns will become much more of a driver than the nearer term policy of the FOMC and the Fed.
And Alex, just to put a fine point on it here, what would be the ideal scenario for equities in your estimation in terms of both the presidency and Congress? I assume it would be split Congress, but then do the markets have a preference for either candidate at this point?
Yeah, that's a very, very good question. I think what we saw during the debate in terms of the market impact was really like a mini window or a microcosm of how the market views it. And in terms of, I think that Trump had the better of the debate. We saw equities rally, we saw the dollar rally, and we saw bonds sell off. And so I think in the short term, that would probably be the best scenario for equities. But again, it's conditional on these fiscal concerns not really arising. So a split Congress, potentially with a Republican president, is something where the market, the equity market, would probably rally on.
Well, we'll check back in as we get closer to it all. Thanks a lot, Alex. Appreciate it.
Thank you.